The gentleman from Illinois, Mr. Dold, is recognized for 5 minutes.
Thank you, Madam Chairman. Director McGrath, as you know, the Volcker Rule prohibits or places restrictions on certain types of financial activities deemed high risk or that create potential for high exposure to taxpayer losses. Insurance companies that own or operate an FDIC-insured thrift institution are covered entities and therefore must adhere to certain restrictions mandated by this rule. Everyone recognizes the Dodd-Frank statutory exemption, which would allow insurers to continue proprietary trading activities in their general accounts. This shows that legislators and agencies recognize that investing for insurance companies' general account should be permitted, as these investments are solely for the general account and are rigorously regulated by state insurance departments. Although Dodd-Frank provided this proprietary trading exemption for insurers with small thrifts, there is an open question as to their ability to continue investing in private equity and hedge funds for their general accounts. Currently, many insurance companies invest in private equity long-term to match the lives of their beneficiaries. These investments are not short-term or quick investments. They're along the lines of 10 to 15 years. Additionally, they are well regulated by the state insurance departments, as you're well aware. As the FIO director, one of your principal functions is to identify issues or gaps in insurance regulations. Based on your expertise and experience in state insurance regulation, do you see any reason to prohibit these types of investments?
Congressman, I'm very familiar with the operations of the industry and individual companies within the industry, including those within your home state, my home state as well. I'm also aware that there are a couple rules that have recently been proposed on this subject matter. The Fed, the OCC, and the FDIC proposed rules, and the comment period expires or closes January 12th. The SEC proposed a rule on this subject matter that closes January 13th. I think the CFTC has a rule on this subject matter that's forthcoming. I encourage all interested parties, including the industry, the insurance industry, to submit comments. I'd prefer that those agencies directly involved with the development of that rule here and develop their own views on that.
You understand my concern. You just named several different agencies that are all trying to weigh in on this, and the opportunity to have more confusion and uncertainty is certainly significant. So would you rank over them in terms of what an insurance company could not do, or would you have to, will we have conflicting potential rules out there?
The law is clear that those agencies, independent agencies I might add, are all asked to develop the rule. Treasury had a role in coordinating but not in developing the substance or content of the rule, Congressman.
A couple of weeks ago, the FSOC released another proposed rulemaking notice on non-bank financial companies, which provides more detail on the designation framework. Generally, the FSOC seeks to assess the company's financial distress on the broader marketplace based on three categories: size, substitutability, and interconnectedness. As it relates to insurance companies, it seems that based on the proposed framework, an insurance company may have sizable assets and operations. However, with respect to substitutability and interconnectedness criteria, insurance companies appear to be less systemically significant and thus would not pose a threat to the financial stability of the United States, and therefore should not be subject to the supervision by the board and enhanced prudential standards. Since a principal function of your position is to recommend which insurance companies may be subject to a designation as systemically significant, would you agree that non-bank financial companies should not be subject to a systemically important designation based on their size alone, as scale, interconnectedness, and substitutability of such entities all mitigate the impact of such entities on the financial stability of the United States?
As you point out, Congressman, the Dodd-Frank Act has established the criteria by which institutions, individual institutions, will be evaluated. There is not, of course, a blanket exemption for an industry or category of institution. The proposed rule and guidance are open for comment at this time. I think it's December 19th, or 17th. Forgive me for not knowing exactly the date, but in the middle of December.
Yeah.
In the middle of December, the comment period will close. I encourage any interested institution or industry to submit comments and reply to the proposed ruling guide.
In my last 9 seconds, Director McGrath,
Yes.
would you not agree that an institution that is filed for restructuring through bankruptcy provisions would not be or should not be subject to the SIFI designation?
Without knowing more about the individual company or the myriad variables that might apply, it would be irresponsible for me to answer that question, Congressman.
Thank you. I yield back.